What's up, folks? This is the Investor Weekly News Update for the beginning of October. And we're combining a couple weeks here because the team has been very busy trying to get the new wealthelevator.com website up, which houses all our e-courses, all our projects. And what we've tried to do here and what we'll continue to do is really trying to separate all the curriculum into different floors based on some people are non-accredited. Most people are accredited, but at what levels are you at? Are you $1 million to 2.5 million, 2.5 to 5 million, or maybe even higher than that? We're trying to separate a lot of this content out based on where you're at. But on today's weekly news update, we're going to be talking about the missing retail market, a little bit about millennial home ownership. Sorry, folks, with that icon. I didn't put the icon. It's a baby sucker there. It doesn't mean no offense to that. My team did that. And then interest rate update, as we saw the Fed choose to pause rates this month. I wanted to acknowledge nugget of this week is decoding the economics of a soft landing. So soft landing is what the Fed is trying to achieve by slowly increasing the interest rates and then holding it here for some time. Some will say maybe 6 months next year. And then at the event of things starting to crack, such as banks falling or a big hit to office space, commercial real estate, or a war or something, unless you start to really see the labor market really start to drop. That's what they're trying to achieve, right? They're trying to damage the economy so that inflation doesn't run wild like how it did, but increase interest rates just enough so that you don't have widespread unemployment for it to jump up, more than 5, 6, 10% plus. And then these are the key things that are going to influence this outcome, which is, like I mentioned earlier, the labor market. Right now, we're sitting at low unemployment rate of 3.5%, which is amazing. Pretty much all-time lows for the modern era. You're going to start to see that go up. What the Fed's trying to do is lower inflation without having a huge amount of unemployment. I'm not a doctor, but to me, it's like trying to kill the cancer without killing the patient in the process. Like maybe that's how chemotherapy is compared to chemotherapy, where it's a little bit more like a sniper tool. But I'll stop there because I'm not a doctor. I'm more of an engineer. But anyway, inflation is number 2. Right? Inflation, they want to see that inflation come down. They've been always stubborn to say they want to get it to 2%. And there's some controversy whether that's core inflation or just the regular CPI that everybody talks about. Right now, that's the goal, right? Of course, it's not far-fetched to believe that the Fed could say, oh, we said 2%, but now we moved that metric to 3 because we're at 3 anyway. And oh, by the way, the celebration party is next week because let's just tap ourselves on the back because we did such a good job achieving a soft landing to this economy. The other thing is like consumer savings. And right now, you're getting to a point where people had a lot of liquidity and savings through the pandemic. You might not be. You obviously see some people who were dipping into their savings a year ago. But right now, when they look at the statistics as a whole, they're seeing that we're crossing over a point where most people or the average savings is becoming now negative. People are dipping into that. In addition to this, obviously, like student loans are starting to come up for due. And basically, this financial buffer isn't in place. And then you're going to start to see a lot of these symptoms bubbling up to the surface. These are the 3 things. There's a few other things, but I think as we go through it, I think it's important, at least for myself, I've been like glued to interest rates since June of 2022 and learning a lot, also in a lot of pain too, right? We have commercial like floating debt in a handful of projects. Obviously, a lot of lessons learned with that. But the other lesson learned is have many deals that aren't all bought at the same time, and to diversify your portfolio over a long time horizon, which means if you're sticking your head in the sand right now and you haven't gotten started, or even if you did start investing several years ago and by not investing now, you break the chain in that having your portfolio spanned, I would argue more than 4 to 7 year time horizon. Here are some of Fed Chairman Powell's comments on interest rates and soft landed chances. Obviously, I mentioned at the top, the Federal Reserve has chosen not to raise interest rates. Right now, we're at 5.5. However, potential rate hikes in November or December quite honestly, they're probably playing this safe, right? They're trying to see how long, or what's the shakeout, right? Things are always changing, dynamics are always changing. Student loans are coming due now, and average savings is being decreased, and businesses are adapting to lower orders, lower volumes. The average consumer isn't seeing that, but right, from my perspective, talking to a lot of business owners, that is definitely on the forefront of their mind. They're seeing less orders come through, less throughput. They're constantly trying to recast their numbers from a year to 6 month period to even much shorter month to month or 90-day period. And they're contemplating, do we lay off in anticipation of this continuing on or maybe even getting worse? We're not there yet in terms of a panic, but definitely, I think the sophisticated business owners are at this point, or at least I'm in a couple of business masterminds myself. This is definitely the topics that are happening among CEO levels. The consumer price index went in August, increased a little bit, which is what we don't want to see, to 3.7%, up from 3.2% in July. We should see that bounce back to more of that general decline as we see these next couple of months. But what the Fed did cleverly was they just pushed the can down the road and wanted to see a couple number of months inflation, namely in October and then in November, to make their next decision. And even at that, they may not choose to increase interest rates. If you want my take on it, I think they should just rip the Band-Aid off, get this all over it, jack the rates up, break the economy, and let's get back to normal. But again, I'm in the situation where commercial real estate is heavily impacted by interest rates, where businesses, all your stock market stuff, guys, it doesn't really see the impacts until much later, maybe even 3 months or maybe even a year down the road at this point. So there is going to be pain ahead, in my opinion, for that type of stuff. For investors investing in real estate, it's really inflation, interest rate dependent, because that's what it changes your cap rates and what you can borrow at, how much you can borrow. And then that really what originates your deal one way or the other. And another indicator is that manufacturing and new ordering productions are both down 0.6% year over year. And that was what I mentioned, talking a little bit of sentiment from people in the industry in the manufacturing or other builder sectors there. Now, 1 in 5 millennial responders here from a Redfin survey believe that they'll never own a home. Maybe this is just the whole millennial trying to be a little bit of a little anti on home ownership. They're saying that 1 in 10 Gen Z respondents believe they'll never own a home. Affordability is number one barrier for these folks. And about a third of Gen Zers and millennials say mortgage rates are too high to buy a home. And they're probably right. I would probably argue the biggest thing is a down payment. But potentially in the future, there are programs, or it becomes the normal for people to go in with 3% or 10% less down payments, which I don't think that they can afford a home. And as I've said before, if you guys want to check out my big article on home ownership, I have always said my golden rule is you don't own a home, you don't buy a home unless your net worth is 2 or 3 times greater than that of the home. Meaning if your kids are looking to buy a $600,000 home, they better not buy it until their net worth is 1.2 million. And you'll probably say, that's heartless. These kids will never afford a home. And yeah, I think they should invest. Go buy a rental property like how I did, or start investing your money elsewhere. And then your net worth will eventually grow. Until then, you're going to make much less of a return by putting it in your house. And yeah, suck it up. I rent. I think it's a wise choice. I'd rather take my money and invest. But this survey is, I always look at these surveys and I'm like, man, like some of the top reasons are like, the available homes are too expensive, mortgage rates are too high. I'm not interested in owning homes. So yeah, if you had the money, it might be a different response to the survey, but a lot of these people are priced out. And I think I'm speaking more towards people in our community. If you guys want to join, you guys can join at theater.com/club. A lot of you guys are good savers. You make multiple 6 figures. Definitely folks that, yeah, you can go own your home. Yeah, for sure. But make sure you're investing. And I think a lot of the financial advice out there is wrong. And I think that there's a different way that the wealthy or the soon to be wealthy are doing things. And it's important to get around other people. We're gonna get ready to hit on the road here in a little bit. We'll see some of you guys in Orlando and Houston for some property tours, as we check out some sites and take a look at a stabilized apartment that we have out there. Would love to meet as many of you as possible, but I want to know who you are first. We definitely only want to have accredited investors come out So make sure you guys join up the club and then sign up for that onboarding call with us so we can get to know you a little bit better. As we definitely run more of a closed door type of investment group where everybody knows each other, no random strangers. The one other aspect I just wanted to close out this week with is what's an interesting nuance because a lot of people bought their homes with historically low interest rates, which may or may not come back anymore. I actually believe that after the interest rates go up to 5.75 or 6%, that we're going to see that pause there, but it'll eventually come down, maybe in the next year or two. But I do think inflation is going to hit a second spike. And I think we'll find long-term stability at interest rates, the Fed rate around like maybe 3 or 4%, meaning that I don't think you're ever going to see a home mortgage in the 2, 3, 4% range in our, I don't know. I don't want to say in our lifetime, but man, I don't want to say in my lifetime yet either, but it's just not going to be the norm, meaning that there are a lot of people who aren't as financially sophisticated as us here are going to think that they're going to be locked up in their homes, meaning they don't want to get rid of their mortgage because they think, oh, I'm paying such a low rate on my mortgage. But you guys know, we educate you guys better where you guys know, sure, you might have a low home mortgage, but if your equity is sitting there dead, it's more like what else could I be using with that equity, especially at a certain point, especially in 5 to 10 years from now. You have to jailbreak that money and get it working for you. But the average person out there, and that's what this article is talking about, is this missing resale market where people are just going to be stuck in their homes because they just don't want to let go of that 3% mortgage. And this is where you're seeing a lot of the existing homes just not move, which is creating low amounts of inventory or low supply. And because of that low supply is such a dominating factor here in terms of that demand and supply, you're seeing that prices in the residential side not come down as much as the commercial side, where it is a little bit based off of more on the numbers than this kind of emotional phenomenon that we're talking about here. So there's a little bit of maybe a dichotomy with residential homes being bought and sold where your existing home stock, a lot of people are stuck there, that's not moving. But your new build stuff, that is the stuff that's being transacted. So it's important to note that there's two sides of the residential home market. And I guess we'll close things out. If you guys like this format, let us know. Please, since we just rebranded, the podcast is now the Wealth Elevator. And we feel like this really sets us up, bringing in additional people to take ownership of the different floors, and especially some of the higher floors where a lot of you investors are going to be graduating towards multi-million, 5 million, 10 million plus. The book will come out here in a couple of months. We're getting the final draft done now. And so be on the lookout for that. And thank you all, everybody, for sticking through us to the whole website transition. The new website looks great. A lot of the e-courses are being moved over for you guys. So I appreciate the patience, and we'll see you guys next week.